Hey everybody, I've been coming to you every day so far and talking about the CARES Act, the relief package that was passed just recently. And I want to keep doing that. I want to keep giving you good quality information. Things are changing day by day. And Troutman and Napier, we are serious about your success, the success of your business, but also of your family. And today I wanted to talk about the mortgage provisions of the CARES Act. And the first thing to be aware of, the CARES Act does provide some relief regarding mortgages, loans on your principal residence. And the first part of that, what you need to understand is that the provisions of the CARES Act only relate to federally backed loans. Federally backed loans means that they are essentially insured, Fannie Mae, Freddie Mac, and that's how you can determine if your loan is federally backed. You can go to Fannie Mae loans and do a loan lookup. You can do the same thing at Freddie Mac, and that's FreddieMac.com, or for Fannie Mae, it's KnowYourOptions.com. And if you have questions about that, if you need the actual links, you can email me or message me through Facebook. Now, if your loan is not federally backed, you are not protected by this. However, a lot of loan banks, mortgage loan lenders, sorry, I'm getting a little messed up on my words there, are offering 90-day forbearances. Now, what you have to understand, if your loan is not federally backed and your bank is offering you a forbearance, that may seem like a really good thing, and perhaps it is just what you need to get through this period, but you need to know about some hidden risks with that. First of all, there's no guarantee unless you have it in a forbearance agreement in writing. There's no guarantee that they aren't going to be tacking on extra interest, extra penalties, so forth in a non-federally backed loan. The other thing, and this is the big thing, huge thing, ordinarily, if you get a 90-day forbearance on a loan, that means on day 91, everything that you should have paid, plus extra interest, plus extra penalties during that 90 days, comes due on day 91. If you aren't able to pay the entire amount and get current on the loan, you have just defaulted on the loan. Now, probably banks will continue to work with folks because they can't see another rash of foreclosures. But you never know. You never know. These are not people that you're dealing with. These are corporate entities. So they don't have that moral sense that a human being would, even though human beings make up the corporation. Now, if your loan is federally backed, then you get a moratorium, not a forbearance, but a moratorium on foreclosure activities, but it's only for 60 days. It's 60 days starting March 18th, 2020. That means if your loan is a federally backed loan, Fannie Mae, Freddie Mac, your bank wouldn't be that, but they'd be through those entities. There cannot be an order of sale, no foreclosure judgment entered. You cannot execute an eviction on a foreclosure, even though the sale has already happened. So that's all halted for 60 days. That's not a long time. The other provision in this, and after that 60 days, well, the restrictions lifted. The other thing that you can do, though, and take advantage of this during that moratorium, is reach out to your lender. You can request a forbearance of 180 days. What that means is that you wouldn't be making payments during that 180 days. Now, if your home has already gone through foreclosure and a judgment's been entered, and or it has sold at auction and the order hasn't just been entered yet, forbearance isn't going to do you any good. It's too late for that. However, if you're not in that place, perhaps a foreclosure started, or perhaps nothing like that's happened at all, you can request a forbearance of 180 days. The nice thing about this forbearance for federally backed loans is that there are going to be no additional fees, no penalties, no additional interest. Your regular interest would accrue. And then at the end of the 180 days, you can request an additional 180 days. Now, the problem again is if you get a forbearance, if you get a forbearance under a federally backed loan, you need to have it in writing what happens at the end of that 180 days, because the default is that on day 181, all that comes due. Well, that's just delayed the inevitable. How are you going to, if you couldn't make the payments for that 180 days, you haven't been able to sock away 180 days worth of payments. Suddenly on day 181, what happens? Are you going to be able to pay that loan up in full? Now, most likely that's not what's going to be demanded of you. However, you want to have that stuff in writing. If it's not in writing, the length of time you have to cure, that's the phrase that we use in legal jargon when you are behind on payments. If you're not able to cure that at a given time in the contract, the forbearance agreement itself, if you're not able to cure that, then, and it's not spelled out, then you're in bad shape. Let me see. My video's not working. Problem with Facebook right now. Okay, well, thanks, Larry. In what way is it not working? Because I've got my phone sideways. Is that the problem? Well, I guess I'm going to finish this and try again. It's just black. Great. Okay. Is that the way it looks for everybody? Okay, well, it looks like it's just Larry. Sorry, Larry. Sir is able to see me. So, if Sir is able to see me, I'm going to finish this out. Where was I? Okay, so here's what you can do if you get it to the end of the 180 days. Yeah, so sorry, Larry. It's your phone. Time to get a new one. Maybe you can get a government-backed loan for a new phone. At the end of the 180 days, have it in writing how you're going to be able to cure it. If you're not able to cure those, you need to be aware and consider a Chapter 13 bankruptcy. Chapter 13, and I'd be willing to sit down with you and take a look at it at that point, see if Chapter 13 will work with you to help you to cure the arrears, the back payments on your home loan, and that allows you a 5-year period of time to cure those payments without accruing interest on the arrears. That's a key thing. And that might be a reason alone, even if you have a cure provision in your forbearance, that might be a reason alone to consider Chapter 13, because the interest does not accrue on those arrears. You keep making your regular payment, the normal interest keeps accruing on the principal, that the normal principal. The arrears are set side as a separate type of debt. Hey Gerald, how you doing? So anyways, that's what we're talking about in terms of mortgages. There are some relief. The bottom line is there is relief in the CARES Act for homeowners with your mortgage to get, first of all, if you're in foreclosure, there's a 60-day moratorium on that. That means everything's put on hold. State law level, I know on the state level, we have a moratorium on evictions, period. But that's not federal. That's a state level thing. And frankly, the courts are closed to anything that's not urgent. But for federally backed loans, most loans are federally backed. Then you can request also a 180-day forbearance on your loan. But you've really got to be careful. You got to be thinking in terms of what happens on day 181. How are you going to catch up? And if you get to that point and you're not going to be able to catch up and so you want it in writing. And if you still can't do it, then you really need to look at a Chapter 13. And that's where I would be glad to talk with you and see if that's going to be the wisest course of action. So things are changing day to day. There's supposed to be, I've talked about the payment protection loan through Small Business Association that's part of the CARES Act. There are supposed to be some rules coming out for independent contractors. And those independent contractors can apply for the Paycheck Protection Program loans starting August 10th. That's tomorrow. As far as I know, the SBA system is still overwhelmed and crashed, and none of the banks were able to process those on Monday or Tuesday, so there's a backlog. The loan money is still on a first come, first served basis. So even though everything is crashed right now, if you want to try to take advantage, if you're a small business owner, an independent contractor, a sole proprietor, and you want to take advantage of the Paycheck Protection Program or the Emergency Injury Disaster Relief Loan, both of which are through the SBA, then you want to go ahead, get the application in for the Emergency Injury Disaster Relief Loan. That is, you actually apply for that through the SBA website. For the Paycheck Protection Program, I'm sorry, there's too many names here. You want to go to your bank, a bank that you have a relationship with already. You don't have to rely on the approved lender list on the SBA website. Go to your bank that you have a relationship with and initiate that paperwork. Get your name in the line, and I can talk again about that. Hopefully we'll have new information for independent contractors coming out today or tomorrow. Anyways, that's what I got for you today, and you all take care. Hopefully we'll be able to get back to work soon and get rolling again.